Welcome to the WangHiro podcast, where we answer Malaysians' burning questions about personal finance with fact-based answers.
Equity crowdfunding, or ECF, is a way for companies to raise money privately. It offers retail investors the opportunity to participate in private equity investing for early-stage companies, which used to only be open to institutional investors. Being an investor for an early-stage company offers unique advantages. You have the chance of getting disproportionate returns on investment should the company experience high growth. At the same time, though, investors of early-stage companies are also exposed to the risk of a company that they've invested in going belly up and see every single cent of their money go up in smokes. With this in mind, is it still worth to invest in equity crowdfunding? Welcome back to the WangHiro podcast. Today, we put on an investor's lens on equity crowdfunding and ask, is the risk worth the reward in equity crowdfunding? So John, you are a value investor and you invest in companies on the public markets like Bursa. So how is investing in a company through public markets like Bursa, for example, different from investing in companies via equity crowdfunding on a platform like Pitchin?
I think the biggest difference is actually the stages of growth that they're going into. And not to say that those companies in the public markets don't grow, but companies that raise money through ECF are usually loss-making in the beginning. It would be good that they will be profit-making from the day they start, usually bootstrapped by the founders. And usually those that are profitable from day one, they wouldn't go through this route. They wouldn't go through equity crowdfunding route because they either borrow from friends and family and they don't want to share equity, because this is a lesson that was taught to me many years ago. And only back then I didn't realize the true meaning of it until probably about 7-8 years ago, which was when you take a loan for a company, it's actually very cheap. So I know you'll be like, what do you mean, John? You pay interest, ma. It may be expensive, even let's say credit card interest rates 15, 16%, 18%, right? But when you give equity, it is more expensive compared to bank loans. True. Because equity, once given, is given in perpetuity. You cannot. You have to buy it back, and you may not even be able to buy it back. Okay. But loans is a fixed interest rate, ma. Your business is cash generative enough that you can pay off the interest rate. Then it's cheap, equity. So back to the question about the difference between equity crowdfunding investing versus stock investing is, I think, the stage they're in. I think the differences is also about the scrutiny and the due diligence required to actually list a company via ECF, or to get people to invest into a company via ECF. For a public company, usually they have to be screened by so many people, an auditor, an accountant, probably a legal team, to see whether all their contracts are in order, the company is in order. Then they have to go through a listing advisor, all right, who is usually a background from corporate finance, to go through the whole thing. And then not only that, you have to get through the scrutiny of Securities Commission as well as Bursa Malaysia, right? In equity crowdfunding, you have what we call ECF platform, guys like Pitchin, guys like 133 Ventures. A lot of these platforms, while they are certified by SC to actually raise money via ECF, but the due diligence work will not be as thorough, as extensive as that of a public company. So I think that is where the big difference in me lies. Obviously, there are many, many other minor differences, especially the way that the shares are presented. The third one, very important. ECF raise, you cannot, there's not much price discovery. What do I mean? If it's on a public market, you log into the stockbroking screen, you can buy and sell the shares. But ECF, let's just say, Louis, you bought company A, ECF, you raise money, okay? Then you decided, hey, I found another company, company B, and I'm not interested to stay invested in company A, ECF anymore. You can't log on and sell your shares online. You have to go back to the platform. Okay. I know some platforms are already digitizing, they're creating exchange where you can buy and sell, right? But I think there's years in the making. And because of that, it's so illiquid. And when it's illiquid, there's no price discovery. It's very hard for you to liquidate or exit your position. So I think that is something that a lot of ECF investors have to bear in mind. You think about it, it's like Sendirian Berhad shares being bought and sold openly. Does that happen? No.
Right, right. So I think there's definitely it sounds to me like a lot of new risks that, you know, like people who maybe if they're used to buying shares on stock markets, now if they buy on ECF, they're exposed to, right? So one of it, I think the scariest one for me is the illiquidity of these shares. That if
Correct.
I want to buy another stock, I can't. And another thing I'm curious about is like with stocks listed on Bursa, for example, they need to publish annual reports, right?
That's
they need
right.
to publish where they're standing. How about with ECFs? Is there such a mandate for them to do that?
As far as I know, no, not as extensive annual report like a public company. But I think they do have to publish their annual audited accounts. Again, it can be a three-page account, just an income statement, balance sheet, and a cash flow statement.
Yeah.
But they
Yeah, I
are
think
not.
Yeah, the regulations around that isn't like very extensive at the moment, right?
Yes, yes. And you know, in a public company, there's so many committees. Like there is the audit committee, there is a set of independent directors. There's also a set of there's also a committee where remuneration committee. So whether the CEO, the COO is getting compensated within market rates and all that kind of thing, or there's proper governance, corporate governance structure around a public company. Okay, and that's why it's all this cost money. I think ECF is an alternative where rather than costing so much to actually raise money. Okay, I may contradict myself later about this, but the point of ECF is an easy route, quick and fast, not a thorough due diligence because there's nothing much to dig right now because you're just a startup. And yeah, the corporate governance will not be as tight as that of a public listed company. So that's the risk that most public investors will have to switch when they come towards ECF.
And I think that you know, when I look at it, like the example you give around like buying shares in a Sendirian Berhad company, I think that's very apt. I mean they have no obligation to be transparent, right? To
Correct.
the investors. You're basically borrowing money to them in return for some equity.
Yes.
Okay, so
yes.
So let's say I am an investor, potential investor looking for looking at a potential investment via ECF. There are a few ways that I can gather information. Obviously, if the company has a website, they have a business, I can investigate those. But then there's also the details on the fundraising page itself, and of course, a webinar if they so decide to provide. So, John, if you take a fundraising page, let's say one from Pitchin, and look at the details, do you think there's enough information for a potential investor to make a decision on?
Yeah, great question. And I think more importantly is this, before we even go there, what is your own competency? So, okay, let me describe it this way and why is that question pertinent? SC has given licenses to a few ECF platform providers. And technically, they should help vet potential pitches before they actually get on their platform and to do the due diligence work. If you're lucky, some of them are very seasoned in the investment world, but they may not be seasoned in the industry this business is in. So what happens is they are also blindsided about a certain projection, a certain assumption how big this industry will grow. Okay, and Usually the anchor points will be around numbers, all right, potential revenue, potential profit, and all that kind of thing. But there's only half the story. And why is this important is because if you don't understand the size of the potential of the industry, whatever projections you put in the numbers may not necessarily be realistic. And the struggle is most of the time when you look at a fundraising page, it will give you a very brief overview about the industry, it says potential, how it grows. But that's the story from the owners themselves.
Yeah.
If it's a public listed company, you have to actually pay and what we call an independent market researcher that actually writes a section for you in your prospectus, you know. It's not from you.
So like what does the market researcher do? They will independently conduct a research
Precisely.
around your industry. Okay.
So if you go to any public listed company, including Leap Market, so there's 3 boards on Bursa Malaysia. You've got the main, you've got the ACE, and you've got the Leap. The Leap is over the lowest tier. Even Leap listed companies, you still have to engage an independent market researcher to actually write about your industry, to research and dig about the industry, and to understand who are the competitors, what's the size, that kind of thing. ECF, I've seen some decks. Most of the time, they omit the fact of their competitors. Most of the time, I'm generalizing, obviously, and most of the time, what I see is when they talk about the industry insights, it's from themselves, and yeah, that's where there's this question mark about the veracity and the angle in which they're showcasing lah. Now, your earlier question about is it enough? Let's walk through an example, Louis, about one that you've researched about. And we are not offering whether it's a good or bad. We're just laying down the facts and using some numbers to get you guys to think about whether it's a good investment or not, right? So let me just start sharing my page. Okay, this is actually something from Pitchin. It's this company called MTTC College, and they're a college on TVET or Technical Vocational. What does E stand for already? I forgot. Yeah, but it's TVET lah. It's vocational education and technical training, right? And obviously, you guys can go and read it and understand. But I'll want to showcase a few things that you should look at first. There's a profile of the guys. Usually, I zoom in straight into what we call the offer table. It means how much are they raising, and what kind of indicative equity are they giving. So in this case, they value the company pre-money. That means before they take in outside money, the founders, original backers, they value it at 13 million. I don't know what's the basis of this. To be honest, I don't know what's the basis of this. Obviously, if you're in a session with them, you can actually ask them. They should be able to tell you. But I'll focus on what is given in public lah. They want to raise a type of share called Redeemable Convertible Preference Share, or RCPS, and ordinary shares. Now, herein lies, I'm very sure you ask, what's the difference? So, Redeemable Convertible Preference Shares, you are not actually a share. You think of it as like you're taking a bond or an IOU with the company, and at a certain period of time, you can convert these RCPS into shares. But at the point where they are RCPS versus the ordinary shares will have voting rights. You do not have voting rights, even though you may have a very big chunk of the RCPS. So let's just say one day you differ or there's a misalignment between what you think the company should be doing and what the company founders are doing. You cannot vote them out. You cannot, even though you hold a big chunk, right? Of course, obviously you can take them to court, whatever, but obviously there's a very long route. But think of it is RCPS, you have no voting rights. Ordinary shares, you have voting rights, okay? So in this case, they want to raise between 500,000 to 1.5 million. And if you see this thing that says post-money valuation, is 500,000, you add to 13,333,625, you get 13,833,625. It means you have enlarged the pre-money valuation to post-money valuation by 500,000. Okay, and to get an indicative equity is very simple. You just take 500,000, you divide it by the enlarged post-money valuation. This is the indicative equity that they're giving out, the indicative shares or the percentage of shares they're giving out of the whole company. Obviously, if they raise 1.5 million, then it will be more, but at the same time, it is actually at a more expensive valuation. I'll show you this later. So far, so good, Louis?
A little bit overwhelming, to be honest.
Okay.
And
Okay.
I'm especially curious about the RCPS shares. So that's the only type of shares that are offered in ECF. Is it in this ECF? Is it?
No, there
So
are two. There are two.
Okay.
So if you look at the offer packages, let me zoom in a little bit. There's two. Most of it is an RCPS. Okay. So if you can see, there's this offer packages,
okay.
premium, bronze. You see number of shares.
Mhm.
Okay. But if you go to the highest tier, in which you invest 500,000, you get ordinary shares.
Okay, so I don't think the common retail investor will be getting ordinary shares then.
Unless they want to put in 500,000.
Unlikely lah. Yeah. So
Yeah.
so like let's say I have 5,000 ringgit, I'm very likely to get I'm 100% sure I'm getting the RCPS lah, basically.
Correct. So 5,000, you'll be bronze. You get 80 RCPS shares, and you'll be getting 0.0337% of the company lah.
Okay, so
And
even though I'm getting equity right here, right? It's listed I have 0. something
it's not equity,
percent.
it's RCPS.
It's not wait, so it's
It
not
is only equity once you convert. So at the point of time when you buy, it's not yet converted to ordinary
Oh, I
shares.
don't even own equity.
No, not yet.
I didn't know. Oh, so when can I convert again? When can I convert?
It all depends on the terms of the RCPS.
Oh, wow. So there's an extra layer that
Yes, you have to read the terms and
consider.
conditions, because some RCPS, they allow you to automatic convert. Some RCPS, there's a timeline, there's an expiry, all these kind of things. So I cannot comment because I don't have that detail. So at this point, you think of it as an IOU. You know what's an IOU, right? Yeah.
Interesting. So my question is, why would companies like sell you that instead of ordinary shares outright?
They want to raise money, and at the same time, they don't want you to have a hostile takeover the board.
Okay, but the equity offer is so little, right? 3.61. Can they do that? Like, can all the, like at let's say 10%?
They can. Okay. So this one usually happens in the public market space. Private companies also it happens, but obviously it does not showcase in the media. So not many case studies I can quote on. Public companies, what they do is they buy up a substantial stake, sometimes even up to 30-40%. And then what they do is they start demanding board seats on the company, board of directors seats. And then they say, hey guys, you guys are not excreting value from the company. You got to split it up. You got to fire more people, all that kind of thing. And I think one of the key reasons why they don't want you to have ordinary shares is because once you have voting rights, it does come into the crosshairs of the management if you disagree with them. And that's one of the main reasons why they don't give ordinary shares.
So other than like the voting rights, what, like, am I in a more disadvantaged position if I have these shares?
I think for the retail investor, most of them don't want to get involved in the business. You see, they just want to be a passive investor. They're looking at, I think the most enticing thing for them is that 6% per annum dividend. Because for them, if I put money in fixed deposits, I get what, 3%? Okay, I put it in shares, unless I have the skill to find high dividend yield companies like, maybe a Maybank, and then they said, hey, but Maybank, yeah, they're giving me 6-7%, but then they're not growing. They say, oh, I'm buying a startup, it's growing really fast, and they project, I'll show you the model that I built later, or I'm growing 100% and 50% every year, that kind of thing. So it doesn't seem enticing to them, you see. So for the retail investor, what do they look at? If you were to simplify it, right, they want to look at some kind of cash flow, in this case, dividend. And they do not want to do too much due diligence. It's like, hey, I'm not in this industry, I'm an investor, I may be, selling cupcakes for God knows, and that's how I got my money. And then now, hey, I want to buy or invest into something. Someone runs the business, and I'm getting a dividend, and I'm growing the company. So most of the time, they won't dive that deep,
So it's fine.
Sorry,
it's fine for retail investors to get these kind of shares. No problem. No other disadvantage other than no voting rights, right?
Yeah, no voting rights. Yeah, and you have to trust the company because the company is your steward of, and they have the steward and fiduciary responsibility of making sure that the money you invest in them was actually spent correctly lah. They did tell you what they're gonna spend it on. It's actually here. There. 50% for capex expansion, maybe most likely a building or something. 25% for marketing branding, 20% working capital, and 5% for others. I don't know what's the others. And they plan to utilize this within 12 to 24 months. Yeah. Usually for this, public listed companies also have to do this, but they scrutinize you like hell for all this. And they will actually, for public listed companies, every quarter or every year, you have to report how much you're spending already on all this. I'm not too sure whether for ECF, I've never invested via Pitchin before. So I don't know whether they have what do you call it, the mandatory requirement for them to report how fast are they spending this money. Because if they spend money, it's actually a good sign, meaning they're actually working on the money that you gave them. You see. Yeah. They're not diverting it to some
car.
like a car or yeah.
Okay, got it. Okay, continue, John, with the
So coming back to this, I think once you understand this, then the next question is, I'm buying this equity 0.003 or even 3.7%, 3.37%, sorry. What kind of valuations am I buying them at? I think that's a more important question, okay? And let's do some benchmarking. So I modeled this out, okay? I've actually briefed you guys about this, okay? But let's just say here was their assumptions. So they gave an overview of the market. This is who they're targeting: 400,000 students a year who are SPM leavers. They plan to capture 0.1 to 0.3% of the market. They say they're operating in the C region based in Malaysia, and they're gonna offer online courses to Cambodia and Indonesia. Okay, so these are the courses they offer. They did give the competitors, which is good: Mobius Capital, CSD Academy, and Blue Pillar. Okay, now what they wanted to share, where was it? The growth. Okay, here. So the traction they have. FY just stands for financial year 2021. So in 2021, they made about 495,000 in sales or revenue. In 2022, and I'm guessing because he said June 2022 to March 2023, I'm guessing their financial year end is in May. That's my guess because they said this 9, but I could be wrong, okay? So, 495 in 2021, 443 in 2022. And what's the projection? Here was the projection. They said that the enrollment growth rate is going to be 100% per year from year 1 to year 2. So I consider year 1, 2023 and year 2, 2024, okay? And then from the 3rd year to the 5th year, the enrollment growth rate is at 50% per year. Now, let me ask you, Louis, you're a business owner. Is it easy to grow sales 100% a year or not?
Not every year, no.
Yeah, maybe when you're starting off small base.
When you're small, then it's easy because you start small, right? If it's 1,000, it's easy to grow to 2,000, 10,000 to 20,000. But once you reach 1 million, then can you go to growing to 2 million will be a bit harder. Yeah. Correct.
So the advantage, obviously, like what you said, they're starting from a small base or so. So I actually modeled it out, and I said, okay, 2021, this was the revenue. 2022, and they said that 100%. So what I did was they're expecting 700,000. No, for year, they're expecting 700,000 for 2023. Their numbers are not mine. I'm not putting numbers into their mouth. Okay, this their expected. So 700,000. So I put it here, year 1, and then year 2, growth of 100%. So 1.4 million. Okay. Year 3, they said 50%. So I take 50% and multiply across the board all the way until year 5. That means 50% growth, 50% growth, 50% growth. Now, they didn't break down what's the profit margin here. So I had to make an assumption. And I made an assumption of 30 and 25%. Now, any business around the world that consistently has 30% profit margins, would you not agree with me that it's actually very, very good as a business?
Yeah, it's very good. It's
very good, right? Net margins. So I'm giving them benefit of the doubt. Fantastically run organization. They can generate 30% margins, all right? Service-based business. So this is the profit that I kind of tabulated. And let's assume if it's a 25% kind of profit margins, then this is the profit I'm looking at. Now, what am I trying to do, guys? I'm trying to use benchmarks to determine whether this is a cheap or expensive valuation that you're buying into when you're raising this money, when they are raising this money. Now, I never said this has nothing to do with whether the business is good or bad. This is the point where we determine whether it's cheap or expensive. Whether the company is good or bad, you've got to determine for yourself a few subjective factors. Are they in the right industry? Are they actually at the point of time today? Is it right for a disruption for Tibet? Are the founders actually someone that have a track record that will be able to execute? Will they get their marketing strategy right? Are they sizing up their staff right enough? All these are very, very subjective and not quantitative methods that you need to evaluate, but it's very important. At this point, I'm only coming from a subject of valuation, cheap or expensive, okay? So in 2021, based on the pre-money valuation, and they're going to raise in 2023 500,000, they are actually, I'm assuming that they are actually 20 times of sales, because the sales is they say is 700K ma, and I'm raising 500,000. Okay, so my price to sales of the post money valuation is actually 20 times for 500,000 raise. If my post money valuation for 1.5 million raise in 2023 based on the sales figure of 700,000 is actually 21 times price to sales. So nothing to do with profit. I'm just assuming that they can grow sales at many clips very fast. Most companies who don't have a profit use this as a benchmark. A very famous company that I can share as an example is actually Shopee or C Limited. Okay, let's go to C Limited. Okay, and this is a public company. Everyone knows. That's why I use this as an example. Okay, so here they are. C Limited for year ending 2023. The financial year is actually June 9th, 2023, or just a few days ago. Okay, the valuation is actually, oh no, this is the latest 12 months. Sorry, we should use this one. March 31st, 2023. They are being valued at current 3.6 times in March 2023. Okay, 3.6 times of sales. If you look at MTTC College, for them to get to 3 times of sales, when is that going to be, Louis?
Wow, that's 2027 according to you.
Yeah, according to my table, right? That means they have to grow, execute very well based on their own assumption over the next 5 years to hit a sales of 4.7 million. Okay, this is not assuming whether they're profitable or not, just sales only. Only then they can be at the same par valuation as someone as big as Shopee, who is present in Singapore, Indonesia, Malaysia, what other countries? Philippines. Yeah.
Okay, that's interesting.
So
I mean,
when
when we buy like shares in a company, this is the key determining factor whether it's cheap or expensive, right? So
correct,
right now
correct.
at 33.21 is very expensive. Seems like almost 10 times more than Shopee.
Yep. If you're buying today, based on the previous evaluations, post money, and the track record of the revenue, you're buying it for 20 times sales.
Wow.
Yeah. So I want you to think very carefully about it. Okay. Only if they execute very well until the 5th year, then you bring down the valuation. So think about the risk over these 5 years, to bring it down to 3 times. I'm not saying C is a fantastic buy, but what I'm saying is C, with the scale and the size they have, they're not profitable, until today. See, they're not profitable, but they went for a loss leader strategy, built the scale first, all that kind of thing. Okay. Now let's go down to the other table where I assume that their profit margin is 30%, which is actually very, very high, right?
Yeah.
And even then, if you're buying at 700,000 revenue with a 30% margin, is 210,000 ringgit profit. You're buying them at 66 times price to earnings. 66 times. Now, let me give you a benchmark. Apple. You would argue one of the best
Yep.
things in the world, right? Okay.
The FANG companies.
Yeah, and huge, right? Who has not heard of Apple? No.
Let's not
Look at
use
the-
an Apple product.
Yeah, I've got an iPhone. I use a MacBook Pro. I use AirPods Pro. I use AirPods, not the Pro, but AirPods, right? I have an iPad. Yeah, they are selling to you at a P of 30 times. Okay.
Hmm.
So if you're buying MTTC, you're buying them at a P of
Twice.
66 times, assuming you have the same margins of Apple of
Right,
30%, right? So Apple has a margins of about 30% operating margins over here. You can see, label, and they sell an ecosystem. They sell software. They sell hardware. This is technically a service-based business, MTTC. Technically, you don't have any hardware inventory costs, and you should have higher margins as compared to a normal brick and mortar business. But even then, to get 30%, before the podcast, Louis and I showed Louis Accenture. So maybe I can show it here also, Accenture. They don't even make that kind of margins. We're one of the world leaders in consulting business, apart from McKinsey, Bain, Boston Consulting Group, okay? So, yeah, they only make about, operating margins. You're talking about high teens, Louis, 15%.
Well, I mean, it just seems like just from the price alone, seems really expensive, right? And I think definitely there are risks of buying in shares at this kind of valuation.
Precisely.
So what would you think like the riskiest thing if I am an investor, I buy like a share at this kind of really expensive price? What would happen?
So many execution risks, also valuation risk. Because you see, remember earlier I talked about ECF where there's no price discovery?
Yeah.
Because it's in the private markets, hopefully, the guys like Pitchin or whoever is in that space, right? If they can create a price discovery platform, it's traded like a normal public market share, right? Probably the valuations would be what do I say, more transparent and more realistic. Okay, but at this point of time, private markets, you are always at the losing end of liquidity and transparency, and your struggle will always be this. Even if, let's just say, someone will want to buy it at 66 times, can you imagine the transaction friction that you're going to sell it to him at 66? The only way for you to realize the valuation of 66 is someone else bigger buys you out. That means maybe I don't know,
institutional investor,
huge, maybe a Inti College or a Taylor's Group or something. I mean, specifically for MTTC to buy you out, and they buy you at that. But you think that they will take in any high valuation that you will give to them? They will also want to negotiate, And most private businesses exchange hands at PE of between 5 to 8, just to give you a benchmark.
5 to 8. Wow. Okay. So John, like, is it possible? Like, let's say I buy in at 66, and then the valuation actually one day like drops 10 times. Then will I be forced to sell it at 10 times?
Even though you say that's a very good point, Louis. Let's just say the company executes so well, they grow 100%, 50, 50, 50. But when you reach to that point, that the Taylors or the Segis of this world, they come and say, hey, I'll buy you out. Hey, but your market saturated already. You cannot grow. I cannot give you the kind of valuation, right? Then they said, I'll give you a P of 5 or 6 times, right? That could very potentially happen. Yeah, but by then, if you execute really well, it should be a P of 10, right? But they can still press you down to say, hey, I think at this point it's very saturated. 400,000 SPM levers, you already captured like 0.1, 0.2% of the market. It's not going to go anywhere else, right? So I said, hey, I can only cap your valuations at 5 or 6 times. Yeah, it can happen.
And I mean, your shares are locked in as well, right? Unlike the
Yeah.
stock market, when like price fluctuates, if it goes up, you can even
You
like
can't even
go
sell at
sell.
a loss, Louis.
Yeah, correct. So when can we actually sell these shares? Only when there's a buyout?
Yeah, there's a buyout or the guys close shop. I don't know what's the rights. As I said, I've never invested through pitching. I don't know what's the rights of you as an investor, whether you can even recoup anything. But maybe let's just say in a few good years, you can recoup the 6% dividend. If they continue paying, you can recoup 6%. But you need how many years? 100% divided by 6. You probably need about 40 years, 50 years for you to no,
God,
5. If it's 5% would be 20 years. So 6% would be about more than 10 years, 15, 16 years to actually recoup all your money back. 6%, 6%, 6%. Yeah.
Right. Right. Okay. I mean, it sounds like a very, very risky thing to do. So, given these conditions, right? I mean, John, you are a value investor. You've been investing for more than 10 years, right?
Yeah.
Maybe 13, 14 years.
2009, more than that. Yeah, about 14 years.
Yeah, and then like you could build this financial model, look at all of the metrics on the information page, the launch page. But I think that the normal retail investor, let's take me as an example, wouldn't be able to know where to look. When I look at the page, I don't know, what exactly. I actually even missed the offer table. Yeah. So, having said that, right, it's very, very possible that an investor in any crowdfunding, equity crowdfunded company would lose 100% of their money. In fact, there was one case study where a guy commented, left his commentary on the Edge some time ago. I think this was in early May, where he said valuable lessons learned from losing money through ECF. Okay, so this guy named Quest Kwang.
Oh, he's actually a journalist. He's actually a journalist with the Edge, Louis.
Oh, he is not. Is he the investor?
Let me see. I don't know whether I think he was. He invested himself as well.
Right. So this is
Chuang, I think.
Yeah, so this is a very interesting, so he says if you thought investing in public equities was risky, private equities could be even more so.
Yep.
I was in the front row seat when the company I had invested in through an equity crowdfunding ECF platform went belly up. Sad to say, 2,000 ringgit went up in smoke after several years of investment. Wow, I mean, so it begs the question: should anyone and everyone invest in ECF just because they can? I mean, anyone can invest, right? Even if they're not sophisticated, don't know what they're buying. As long as I have like 5,000 ringgit, for example, I can invest. Should they even go in? Like who's the right?
No, I think 5,000 ringgit, right? You know what they should be doing? They should be, if they've never invested in any other asset class before, they should be educating themselves about all these kind of things. Buy books, attend courses, even do simple, learn to do simple valuation spreadsheets like what I just did. I mean, in Quek's article, which I think I want to point out the other example. If you think my valuation was bad for MTTF, this guy, he said, a waste oil recycling company fundraised at 15 million, estimated revenue of 2 million, estimated profit 141,000. In short, the company was valued at 7.5 times sales and 106 times price to earning.
Wow.
Obviously, this one he didn't project towards the future. I gave MTTC a lot of optimism. I said they will execute everything. They can probably bring their price to sales down to 5 times if they execute very well over the next 5 years. Yeah. So again, these are the basic, your premise to this podcast is, what should an investor look at? Should I even be invested? These are the basic stuff that you should even ask yourself. And ironically, if you don't know how to invest well in the public markets, my point of view, and I know I'm going to get a little brickbats, you shouldn't even invest in the private markets. Most private investors that do very well are actually professionally trained, or they invested in the public markets, got the skill set, made the money, then only they venture into the private markets. But if you're someone who is not even invested at all in the public markets and you go directly into the private markets, I think that's something that I feel is not a very smart thing to do lah. I could be wrong. You could be very smart, do very well, but most of those who do very well are, for me, professionally trained to understand all this.
And
Yeah.
I think what they're professionally trained to do, right, is to not lose money.
Correct.
Right? They are professionally trained to study a business, a market, and even ask the right questions. I find that sometimes when you don't know what you don't know,
Yeah.
there is a huge risk, right? To
Correct.
total loss of your funds, complete like
Yeah.
this journalist losing 2,000. I mean, it's not a lot of money, but let's say if you continue doing that, right, for a long period of time, I think you will lose quite a bit of money.
Oh yeah.
Not from just doing this, right? It's just your lack of understanding of what you're investing in.
And the best part is that because of that, they continue to do this with the lack of understanding, Louis. They try to win back the money they lost. So they may even double down on the next one because the story, the pitch is even more interesting than the previous one, correct? Right? So that's where I think I know I'm going to sound like a broken record, but it's always about the skill sets that you have. You need to equip yourself with the skill sets that you have, and only then you go into. I just wanted to also point your direction into something that the Securities Commission actually highlighted. Okay, they came out with a report in 2021. Okay, let me find that right page for you. Then I show my screen. Because I found that this was a perception that kind of painted one of the main reasons why we're doing this episode. Here is it. I found it. I'm gonna zoom in. Okay, so this is the chart. They did a survey. I forgot who did the survey for them. I think AC Nielsen. Yeah, they did a chart on a survey for this. And they wanted to understand the use perception towards risk. Okay. Now, ASB perceived as very, very low risk. So if very, very low risk because you see the high risk here is only 4%. Low risk, the yellow is 59%. So for them, ASB is almost like God-given. Yeah, it's like fixed D. It's like, no one's gonna harm me, right? For them, the highest risk of all, and I'm not surprised by this, was actually stock. 70%. Very high risk. Medium, some say medium risk, low risk 5%, and then don't know, unsure 10%. This is the one that surprised me. ETF, ECF was of a lower risk or perception of a lower risk than stocks.
That is interesting.
Can you see here? Risk is 44%. They did put a caution, law-based, less than 30. But you see, the perception is that ECF had lower risk, very contrary to what Kwek Sir Zhang wrote in The Edge, okay? Very contrary to what I think as well, based on the valuations about ECF. And I think stocks are more risky. You see? So again, to the untrained eye, obviously stocks is risky. To the untrained eye, ECF is not risky. You see, and I think for me it's a bit scary because they see even P2P financing is less risky than shares.
I wonder, John, is it because it's much easier to put money in,
Yeah, because like someone has built a platform, someone told the story, and you say, hey, it's your responsibility, it's SC's responsibility because they've vetted and all that kind of thing. This is the one that really shocked me. Okay, if you think ECF shocked you right now, I know most guys, unless you trade, you heard of this contracts for difference. It's actually banned in Malaysia, by the way. Contracts for difference is actually banned in Malaysia. These are options trading, futures, put options, call options, and all this. This is actually very, very risky. It's even banned in Malaysia. There's only 2 companies in Malaysia that's even allowed to do this.
That's crazy.
So there's one, I wouldn't want to name the brand. It does Forex. It comes on YouTube. Every time YouTube, you will hit. Okay, we should not name the brand. Okay, should not name the brand. These are CFDs.
Oh, interesting.
So when you're doing that, you're trading options. It's actually banned in Malaysia. Yeah, and
Yeah,
it's
again,
actually on the
again,
SC watch list. Actually, this company is actually on the SC watch list.
right.
But you see,
Perception. Also
perception is that it's less risky than stock market.
Mm. Marketing message, no? Oh, it's easy, just put your money in, see it grow.
Yeah,
Of
yeah.
course, it's their bank account that's growing, potentially.
Correct. So
Yeah, so like I think from looking at, I mean, in the future I hope that this will change with some education around this. But it's just sometimes the way that companies advertise, right? Oh, just put this will happen, and then when we look at the launch pages, they paint of course every company will paint a good picture. I mean, I'm not really sure what the third party oversight is with these campaigns, but I think it's worth asking more questions before you put in your hard-earned money, right? I think
correct.
if you're only out there to put in 5,000 ringgit, I think that's going to be a lot of money for you, personally speaking.
Correct.
So, let's say, John, if I am an investor, right, I'm looking at, I mean, I may or may not be an investor. So I'm just thinking, okay, I've seen these ads around, or people have been talking about like crowdfunding, equity crowdfunding. Before I put my money in, what are some questions I can ask myself first? Some
Okay.
questions to qualify the business before I put in my hard-earned money to avoid loss, to avoid losing all that money. Maybe I could put it somewhere else. Yeah.
Do I have the skill set to understand this business? Because eventually when you're buying into equity crowdfunding, you're buying equity into the business. That's why it's called equity crowdfunding, right?
Mhm.
If you don't, then first red flag, cross. Second, what is 5,000 ringgit to me? If it represents like 50-60% of my savings, then I highly recommend you to start reading books and to start building more money. That 5,000 becomes like 0.05% of your net worth. Okay. The third question I would ask is this: what will be the impact if you lost that 5,000? Would it cause you emotional anguish? Would it cause you probably greed that you want to double down on the next investment to make back your money? Okay. Fourth question. I know everyone's impatient to make money. Who isn't? Including myself. I made many mistakes by being impatient. Okay. But here you are, on one hand, you only have 5,000 ringgit to invest or 10,000 ringgit to invest. You want some kind of guarantee return. At the same time, you're lured by 6%. And ironically, you're buying into high risk. So here's my question to you. Very risky, small startup, so many things can fail, versus a Maybank giving you 6 to 7% dividend yield. Okay, the largest bank in Malaysia, 100 billion market cap. Right? Which would give you peace of mind? Now, some people with the more gung-ho gambling kind of mentality, they will say, oh, obviously I'll go for the startup. You can make millions overnight. True. But then question 2 and 3 is like, hey, how much is 5,000 out of your entire net worth? Guys who make money from private investments or private equity, all this, are people who already made the money the traditional way. This is spare cash for them. If 5,000 is not spare cash for you, I highly ask you to think very carefully about the skill sets and the net worth you're in before you're going into all this.
Even like when we consider like VCs, right? VCs who place even like a million ringgit in a startup. That's like out of like maybe a much larger fund, like a 500 million fund.
Correct.
They can place that bet that's only like less than 1% of whatever portfolio that they have.
Precisely. So I think, again, back to the anchor of WangHiro, educate yourself. There's abundant of resources today. I know it's not easy. Louis and I started this channel because we know it's not easy. Because there's information all over the place. There's a lot of marketing material that want to sway you otherwise, but they don't anchor you to the foundation. I think that's key. Yeah. Any last questions from you, Louis?
Yeah. So I mean, I'm thinking about the alternatives. You have mentioned a few already. So if you want a return of 6-7%, you can look at a Maybank. But
Yeah.
so my question would be, if I wanted, like astronomical returns, right? That may be the promise of certain companies. Is it like, what are there alternatives to that? Alternatives to ECFs, apple to apple alternative?
Ironically, I just thought of one, and I actually bumped into him in New York, Louis.
Oh, okay.
Okay, so he's a fellow YouTuber. He creates financial documentaries, Chinese by birth but Americanized, and he actually invests in a platform that invests in art. So okay, so let's just say you want to buy a Van Gogh painting. Unless you're a billionaire, you can't afford a Van Gogh, right?
Right.
Or a Rembrandt or
Right.
whatever. But they actually use equity crowdfunding concepts to actually buy the art. So I
That's
felt that is even better because the tangibility is an art that is already, that has a price discovery, that has a public market, in a way a public market. Obviously, there's still similar risk to like ECF because the company that hosts your money or has custodianship of your money to buy the art, and the ownership of the art doesn't belong to you. There's also another risk. But in this way, if you want to like compare an apple to apple comparison for ECF with the risk, yeah, this is one of the things that I can think of.
Would you say like most people should avoid ECFs? Most people.
Okay, so here boils down to the 4 questions I asked earlier. How much is 5,000 worth for you? What is the skill set that you have? What will the emotional response that you will invoke if you lose this money? And last but not least, are you willing to upgrade your skill to be better at what you do in other alternative assets? Because from my point of view, it's much easier to go into the public markets than the private markets. Obviously, I say that with the bias. I did mention earlier, I never never invested in pitch-in, but I've invested in many startups before. 90% of them, in Hokkien we say "chao hui ta." Chao hui ta means it means barbecue. You barbecue until it hangus, like black.
My God.
Chao hui ta means it's like
Okay.
burn, really literally burn.
Zero to zero.
Zero.
90%.
Or in probably about not up to 100K lah. Close. Because I invest. There's one very interesting one that I invested in right now. A little bit high valuation, but not as high as what I've just shown to you. It makes halal dim sum. Central Kitchen, halal dim sum. I like the business. I like the guy running it. But obviously it's very small money for me lah. So yeah, it's not going to be a 6-7 figure. Sorry?
Went through the checklist yourself.
Went through the checklist myself. Right. Brought other in. Actually, the guy who is structuring the deal for him is actually a public market investor first. He was actually a portfolio manager, public markets portfolio manager. He went into doing corporate finance and he actually structured the deal for them. So I asked him, hey, are you invested yourself? He said he is. So yeah, after doing my own duty, after looking at the structure, I said, okay, they're profitable, by the way. I can't reveal the numbers to you, but I would say roughly about 15 to 20% margins for food business.
Oh, food business, yeah. It's pretty good. It's pretty good.
Yeah.
Usually we see like one figure.
Yeah, single digit kind of figure. Yeah. They run it very lean right now.
So like if we consider a percentage, right, of a person's portfolio, how much should they be investing into ECF if they so decide?
I would say nothing more than 10% or 15%. Nothing more. Yeah. Unless they do it for a living. It's different. If you are if you are a retail investor, you've never invested in other asset classes, or you have some asset classes like unit trust, shares, properties, whatever, right? And you don't do this full time, and this is like a way of diversifying your portfolio. I wouldn't say it's more than 20%. Max or so 15. 15 also I think is quite a lot.
That's in aggregate, right? Or all crowdfund like ECF.
Correct. I think the foundational advice is this, Louis. Put the biggest chunk of your portfolio in something that you know best and you spend the most time is. I learned that lesson very, very well. I got into crypto. I didn't really know much about it. I know enough. But because of that, I burned myself nicely because I wasn't watching that basket. My
Right.
expertise has always been stocks, and yet I didn't double down and more on that. That was a mistake that being vulnerable and transparent about it here. So yeah, I mentioned this a few times before, but it's important.
Yeah. So I think we'll dive deeper into all those in one of the episodes in the future lah.
Yeah.
Okay, yeah, I think that should be it, John. So I hope that with this episode, the audience you can learn more about ECF, what to look for. I think John shared a very valuable financial model. We'll share a version in the show notes as well, so you can do some calculations. Of course, financials are just one part of the evaluation. We're not saying, oh, if it's expensive, it's not worth the buy. There are other factors you should consider as well. And then, when you have a full picture of everything, you can make your own decisions. Of course, with John's 4 questions as a guideline, right? So you can review back what are those questions, also include them in the show notes, so you can ask yourself when it comes to time. So yeah, so if you enjoyed this episode, do give this video a like. And if you want more content about personal finance and unbiased and fact-based, do subscribe to WangHiro's channel. Thanks for your time watching this video, and we'll see you again in the next one. Bye-bye.